Answer: hey there, Iggy the Investing Iguana here. In today's video, we're diving deep into the wild world of Singapore REITs. The big question on everyone's mind, with REITs enjoying a much-needed rebound last week, is the worst finally over for this battered sector? Stick around, because I'll be breaking down the latest updates, analyzing key REITs players, and sharing some juicy insights to help you navigate these choppy waters. Trust me, you won't want to miss this. First off, let's talk about why REITs have been struggling lately. It all comes down to those pesky interest rates. When rates go up, REITs feel the pinch because they rely heavily on debt to fund their operations. It's like trying to run a lemonade stand while the cost of lemons keeps going up, not a fun situation. The U.S. Federal Reserve has been hiking rates faster than a cheetah on espresso, pushing them to levels we haven't seen since the global financial crisis. This means REITs are stuck rolling over their loans at higher and higher rates, which eats into their profits and makes it harder to grow. But wait, what's this? Whispers of a potential rate cut on the horizon? That's right, with inflation slowing down and the job market looking a bit shaky, the Fed might finally give REITs, and everyone else, a break. Investors are getting excited, hoping for not just one rate cut, but a whole series of them. It's like the ultimate buy one get one free deal. You see, when interest rates fall, it's like a breath of fresh air for the real estate investment trust, REITs, sector. Suddenly, borrowing money becomes cheaper, which means REITs can expand their portfolios and take on new projects without breaking the bank. It's like getting a discount on your shopping spree. But that's not all, folks. Lower interest rates also tend to make real estate more attractive to investors. It's like the market suddenly puts on its rose-colored glasses and sees the potential in every property. This increased demand can lead to higher transaction volumes, meaning REITs can buy and sell properties like they're playing a game of Monopoly. Now, here's the cherry on top. Falling interest rates can also lead to something called multiple expansion. It's a fancy way of saying that investors are willing to pay more for each dollar of a REIT's earnings. It's like the stock market giving REITs a big thumbs up and saying, "You're worth it." So, does this mean it's time to dive headfirst into REITs? Not so fast, my eager investor friends. While the recent price surge is a nice change of pace, we're not out of the woods just yet. The Fed's target inflation rate is 2%, and we're still sitting at 3%. It's like trying to fit into your favorite jeans after the holidays close, but not quite there. And of course, not all REITs are created equal. Some are better positioned to take advantage of falling interest rates than others. REITs with discounted preferred shares and those with moderate to high leverage but strong businesses are like the kids who always get picked first for the team. They're the ones who can really make the most of this favorable environment. Speaking of top performers, let's take a closer look at some of the hottest REITs in town. Mapletree Logistics Trust, a logistics powerhouse listed on the Singapore Exchange under the ticker M44U, has been making waves in the market recently. The trust's unit price surged an impressive 7.9% in just 2 trading sessions, closing at $1.36 on July 14, 2024. This strong performance can be attributed to MLT's robust portfolio metrics. As of March 31, 2024, the trust boasted a high portfolio occupancy rate of 97.5%, demonstrating the resilience and attractiveness of its well-located logistics assets across the Asia-Pacific region. Furthermore, MLT has been able to achieve positive rental reversions ranging from 2.6% in South Korea to 11.1% in Singapore, showcasing its ability to capitalize on the growing demand for quality logistics space. The only exception has been China, where the trust is facing a more challenging leasing environment due to economic headwinds and an ample supply of warehouse space. Despite this, MLT remains well-positioned to navigate these challenges by prioritizing occupancy over rental growth in the near term. Looking ahead, MLT is poised to benefit from several key trends shaping the logistics industry. The continued rise of e-commerce, supply chain diversification efforts by businesses, and a growing focus on sustainable buildings are all expected to drive demand for MLT's modern, strategically located assets. With a diversified portfolio spanning Singapore, Australia, China, Hong Kong, India, Japan, Malaysia, South Korea, and Vietnam, MLT is well equipped to capitalize on the growth potential of these markets while maintaining a stable income stream for its unit holders. Keppel DC REITs, the first pure-play data center REITs listed in Asia, is riding the wave of the booming digital economy. With data centers becoming increasingly essential infrastructure, Keppel DC REITs has positioned itself well to capitalize on this trend. The trust recently made headlines with its acquisition of a brand new, state-of-the-art data center in Osaka, Japan. This strategic move not only expands Keppel DC REIT's geographical footprint, but also strengthens its portfolio of high-quality, income-producing assets. Investors seem to have taken notice, as evidenced by the impressive 7.6% rebound in the trust's unit price, which closed at a healthy $1.99. As the world becomes increasingly digital, Keppel DC REITs appears poised to benefit from the growing demand for data storage and processing facilities. Frasers Logistics and AMP Commercial Trust, trading on the Singapore Exchange under the ticker symbol BUOU, has been making waves in the market lately. This Singapore-listed real estate investment trust recently saw its share price jump an impressive 7.5%, allowing it to reclaim the $1 mark. This strong performance serves as a testament to the resilience and potential of the logistics and commercial property sectors, even amidst a challenging economic landscape. FLCT boasts a diverse portfolio comprising 112 industrial and commercial properties spread across 5 major developed markets, namely Australia, Germany, Singapore, the United Kingdom, and the Netherlands. With a portfolio value of approximately 6.8 billion Singapore dollars, FLCT has established itself as a significant player in the global real estate arena. The trust's investment strategy revolves around acquiring income-producing properties predominantly used for logistics, industrial, commercial, or business park purposes. This strategic focus allows FLCT to capitalize on the growing demand for such properties, driven by factors such as the rise of e-commerce, the expansion of reverse logistics, and the reconfiguration of supply chains. CapitaLand Ascendas REITs, CLAR, is a powerhouse in Singapore's real estate investment trust, REITs, market. As the country's first and largest listed business space and industrial REITs, CLAR has built an impressive portfolio since its listing on the Singapore Exchange in 2002. With properties spanning Singapore, Australia, the United States, and the United Kingdom/Europe, CLAR offers investors exposure to a diversified mix of assets across key segments like business space and life sciences, logistics, and industrial and data centers. What sets CLAR apart is its strong focus on technology and logistics properties in developed markets, positioning it well to capitalize on the growing demand in these sectors. The REIT's portfolio is anchored by strategically located, high-quality properties that cater to a wide range of industries, from engineering and biomedical sciences to financial services and electronics. Over the years, CLAR has demonstrated a track record of steady growth and resilience. In FY 2023, the REITs achieved a significant milestone as its net property income surpassed 1 billion Singapore dollars for the first time since its listing. This achievement is a testament to CLAR's effective management and its ability to navigate through challenging market conditions. Now, I know what you're thinking, Iggy, this all sounds great, but how do I pick the right REITs for my portfolio? Fear not, my friends, because I've got you covered. First, look for REITs with a strong sponsor. A solid sponsor can provide financial backing, pipeline assets, and even help secure better borrowing rates. It's like having a rich uncle who's always got your back. Next, check out the REIT's occupancy levels. High occupancy means steady rental income, which translates to juicy distributions for you. Aim for occupancy rates above 90%, the higher, the better. Finally, keep an eye on the REIT's debt profile. You want a REIT that's not drowning in debt, especially in this high interest rate environment. Look for REITs with a healthy gearing ratio and a well spread out debt maturity profile. In conclusion, while the recent REITs rally is encouraging, don't go betting the farm just yet. Keep an eye on those interest rates and inflation numbers, and focus on quality. Slow and steady wins the race, especially when it comes to building a rock-solid investment portfolio. If you found this video helpful, be sure to smash that like button and subscribe to the Investing Iguana channel for more juicy insights and analysis. I'll be spilling all my secrets and showing you how to navigate the REITs world like a pro. That's all for now, folks. Remember, investing is a marathon, not a sprint. Stay informed, stay patient, and stay cool, like yours truly. Until next time, this is Iggy the Investing Iguana, signing off. Share. Rewrite.